It looks like it's going to be another tough day on Wall Street after the Federal Reserve once again raised interest rates. The Fed announced yesterday that, as the market had expected, it was going to raise the benchmark rate. The mark move, that was a fourth increase this year, and the ninth since the central bank began normalizing rates 3 years ago. So, Steve, you got some charts for us to put yesterday's decision by the Fed, put it a little more in context. What in the world is going on?
And now I have to be serious, right? No more babies.
Yeah, no more babies.
Okay,
down to business.
Down to business. First, let's take a look at what happened. The stock market has had a rough several months, and in fact, when you add it all together, the stock market is back to where it was 15 months ago. It's back to where it was before Donald Trump's tax plan that was going to make America great again was put in place.
But by the way, it's down what? What percentage is it down since? I mean, 2, 3, 4% since the tax cuts.
Oh, since the tax cuts, yeah, it's down 2, 3, 4, 5%, something like that. Yeah, and this is actually going to be the worst December since 1931. For the stock market.
Which, by the way, wasn't a great year.
Not a great year in
1931.
Not a great year in 1931. So why is this happening? And there are a lot of reasons. It's always hard to decipher the stock market even after it happens, let alone before. But global growth, slowing global growth, is playing a role. So we'll take a look at those numbers. And if you look over here, you can see that on a global basis, growth is coming down from, is projected to come down from 3.2% to 3%. Now, that may not sound like a lot, but that's a couple $100 billion when you look at it across the world's economy.
Well, and you look at China, let's put this back up. It wasn't so long ago that China was experiencing 8, 9, 10% growth. Now, of course, you've shown, the past couple of years, and it's down now a couple of percent to 6, but quite a change over 5 years.
Yes, but remember also that China makes up their numbers to some degree, and so there are many fears that China is actually in much worse shape than what you're looking at
so
here.
They may not even be at 6%.
And then what you're looking at here. And for the U.S., we're looking at growth somewhere in the 2.5% range next year, which is a long way from the 3% plus that Donald Trump told us we would get.
So let's ask, let me ask you, is this just, you look over 100 years and there's an ebb and a flow. There's a recession, there's a recovery, then we go back down towards the recession. Isn't this just part of a natural business cycle?
To some degree it is. Economists say that recoveries don't die of old age, except that they do, and we are at the tail end, as you say, of a long business cycle. But nonetheless, it's very possible that Donald Trump will be facing a recession in 2020 as he runs for re-election.
What do you say?
We're in that cycle. Why?
Yeah.
Let's look at just this last chart for 1 second, and you can see what the world thinks is going to happen to interest rates, which is an arbiter of the future. So the Fed has been bringing down its interest rate projections, and you can see that up here. And that was part of what it announced yesterday. But the market thinks this is what's happening in interest rates. The market thinks that interest rates might go up a little more, but then in 2020, they will be actually a little bit lower than they are today. Now, that's good news for borrowers. It's good news for people getting a mortgage, but it's a signal that the market thinks there's a bunch of economic weakness coming.
Globally, what is the biggest driver to stagnation that we're starting to see?
You know, it varies. Europe is a mess. You've got Brexit. You've got Italy, where the banks are in trouble. You've got Germany, which actually had a negative quarter of GDP growth. You know what's happening in France.
Right.
So they've got a whole set of problems. China's got a set of problems where Xi is trying to manage the economy, but it's not working that well, and where they're overbuilt, overinvested, over in debt. And then in the U.S., we had this sugar high from the tax cut, from the spending that's worn off. And now we are drifting back toward 2% growth, maybe worse. And
I know we have to go. They keep telling me we have to go, but I just have to ask this question. I did the setup.
I can stay as long as you can.
I have to ask the final question. So you look at what the world's looking like, what the EU's looking like, what Britain, Germany, what China, Russia's like. The United States of America still is the safest port in the storm, right?
Well, China's going to have higher growth, but in terms of basic, among the developed world, we will have the fastest rate of growth, even under these circumstances. That is true.
And as far as long-term stability, we don't know what's going to happen to China.
But as you often point out, we also have one of the worst fiscal positions of any country in the world, and that's going to come home to roost at some point, too. But look, the bottom line, I think, to some degree, is that Donald Trump is not going to be running 2 years from now with a 3% plus growing economy and wages having gone up a lot for the average American.
All right, Steve, thanks. That was great. Up next, we have a pair of U.S. congressmen from opposite sides of the aisle. We're going to get their reaction to the president's new Syria policy and the push to avoid a government shutdown, now just over 1 day away. Morning Joe, back in a moment. Thanks for checking out MSNBC on YouTube, and make sure you subscribe to stay up to date on the day's biggest stories. And you can click on any of the videos around us to watch more from Morning Joe and MSNBC. Thanks so much for watching.